Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty. And sorry we missed you for a few weeks. We actually had moved into a new property and been pretty busy with moving and unpacking and selling our other house. And also we were out of town for about a week in Vegas for a conference, a work conference. So it was kind of a working vacation. But in any event, we're back. And I just wanted to make this video because there seems to be so much confusion out there, a lot of bad information on what's going on in the market. And this is going to be more of a kind of an overall view of the country. Usually we do our weekly market updates most of the time as far as market updates go for the Phoenix metropolitan area. We'll be doing that also this week. So this will be in addition to that. And this will be kind of looking at, with inflation and interest rates, when is this pain going to end, basically, is what everybody's asking. Is this going to go on forever, or is this ever going to change? Where's the end of this? So we wanted to kind of get through that with you and look at the details of all this. So how long is this going to last? And a lot of people thought we had peaked in inflation. We had inflation was going to be transitory, and that wasn't the case at all, as we had mentioned a couple of times to you in the past. So, what actually drives mortgage rates? It's not the Federal Reserve. It's not the government, although indirectly they can do things to influence that sort of stuff. It's really inflation that drives mortgage rates. Okay. So, most people, majority, well over 90% have fixed mortgage rates right now. And then, the remaining 8% or so have hybrid fixed or adjustable rates. And so, fixed over a certain period of time. And when investors get involved in this and they see, that they're getting a check, let's say, for $2,000 for their investment, but then they look at, okay, that check I got for $2,000 can buy this set of goods for me over here, but over time that inflationary factors eat into their profits. So now when inflation, when inflation was very low, say like 1-2%, buying power was pretty well intact in the short term. But there's been a lot of erosion to their buying power. So when they look at new loans, what those are going to look like now or in the coming future, they have to look at where inflation is headed, and what's going on with these sorts of factors, right? Because they obviously aren't doing this for fun. They're it's a business. So there's two different inflationary factors that everybody's looking at. And again, I'm not an economist. I want to tell you right now, I'm not giving anybody advice, economic advice or whatever. Just a disclaimer on that. Always talk to your financial person and CPA and all that good stuff, and your attorneys. But as far as real estate goes, I want us to kind of talk about, how this affects it. And so they look at PC and CPI, which are the two inflationary measurements, the consumer price index, the personal consumption expenditures. You see the headlines all the time in the news, if you watch the news at all. That's the overall number. Sorry about the allergies. And then they strip away food and energy, and you get your core inflation. That's risen dramatically. It's in the 4.9 to 8.1% range, depending on which metric and measurement you're looking at. But that's significant. So what that means is that prices are going up. So buying power is being eroded more rapidly. So an old mortgage is already fixed, it's already done. But new mortgages that they're issuing, they've got to look at this and, basically charge more money to borrow money. Okay. It costs more money to borrow money. So therefore, the only way that they can offset this inflation is with this erosion going on is with interest rates. So what is inflation? It's basically too many dollars chasing too few goods, and it's what's driving everything right now. And so just like anything else, if there's much more buying or buyers bidding on goods, well, then the price goes up. Okay. So what the Fed wants to do is they want to come in and they want to do what's called demand destruction. This means they want to take those dollars away from the market and they want to destroy demand. Okay. So how do they do that? Well, we just said that the Fed doesn't control mortgage rates, but the Fed does control pricing of money, which is called the Fed's fund rate. And the Fed's fund rate does directly influence things like credit cards, car loans, equity lines of credit, personal credit lines. One big thing would be commercial or industrial type loans. So let's take, for example, just at kind of the street level, a car loan. $60,000 worth of credit on a car loan, let's say, or a lease, which is credit as well. If you had to buy that with cash, most people probably wouldn't buy the car. But when, you get the, $60,000 in credit, you just, sign and drive, right? It's a big turn. The money just kind of comes from the keystroke and poof, the money's there. That's an inflationary money appearing out of thin air, basically. And you do that for roughly $17 that's in our economy. And $16 of that is generated by credit out of that 17. So you think about it, how our economy runs on credit. Now with the Fed trying to do what the Fed's trying to do is make it painful to borrow money. Okay. They want you to stop borrowing money and save your money, basically. So when the payment is very low, the consumer may go out and buy a car, poof, $60 in credit, because on the other end of that, there's going to be a payment. But if you make the rate higher and make the payment higher, then the borrower has to qualify to contemplate that, well, that's a big payment. I'm going to have to choke on. So perhaps I'll just wait a little bit longer. I'll keep the car a little bit longer. And therefore you don't have that infusion of the magical inflationary $60,000 in this case. So the same thing is with big money or commercial or industrial. Want to borrow 500 million to buy or build a factory, or 1 billion to acquire a company. Well, then the Fed funds rate, when it's at zero, I'm paying a little bit of a margin above the Fed's fund rate, maybe, and the economics make sense. But now with the Fed's fund rate, going 3, 4, 5% or higher, then if we're looking at those numbers, and we're wanting to they're looking at wanting to start at 6, 7%, maybe. In $1 billion, it's very different. So if we're at 2 or 3%, it might make sense for the $1 billion, than opposed to the 6 or 7%. So what they're doing is destroying demand, slowing demand, and so you won't borrow the money and add those dollars into the economy and add more inflation. So we went through a global pandemic. Lots of money got printed for a lot of different programs and payouts and checks that went out. That increased a lot of the inflationary factors that we're seeing currently in the last couple of years. Also, we had some other things come up, like, the infrastructure, quote unquote, act, which not a lot of it was really infrastructure, already into an inflationary environment. And voila, here we are. It's like a arsonist becoming a firefighter. We're trying now to, we started the fire over here and now we're trying to put it out. So, they want to disincentivize you from doing these sorts of things, getting the credit, and they want you to save money. And you actually, then with the shift in things, that actually you could get a better rate of return. So here comes the Fed. They hike the rates. By hiking the rates, what they do is they try to pull these dollars out of the market. I mentioned savings. Right now treasuries are really looking really good, and they're looking really attractive. 6-month, 1-year treasuries backed by the full faith credit of the United States government. So you get your principal return for sure, but even shorter maturity, like 1 year, pay over 4% if you wait till November 2nd when the Fed will hike rates again. You'll probably be looking at about 4.5, maybe even higher than that. So for a completely rest-free return, that's pretty attractive right now for a lot of people. A lot of people are doing that for kind of a sure place to park their money. So what the Fed is doing is trying to make savings more of an incentive, and therefore, when the Fed hikes come, instead of spending it, you're saving it. So it takes that money out of the economy, you have less dollars out there, and now we're also goods are coming back, supply chains are coming back, and because people aren't buying as much, you start kind of having the effect of stuff maybe piling up a little bit because people aren't willing to pay for it. So then you have too much inventory eventually. We're kind of seeing that crest, believe it or not, in some sectors. And then what happens when you have too much inventory? You have sales, right? To get rid of it. You got to get it off the shelves, you got to move product and go on. So we're going to start seeing that shift over the next quarter or two. And then, now with inflation and how this relates to mortgage rates, as inflation goes up, mortgage rates go up. As inflation comes down, mortgage rates come down. Now, here's the thing. From January 2020 to January 2022, when the Fed buys mortgage bonds, to the extent that they fix the price of mortgages around 3%, you had a curve control that they used. Even through the inflation that was going on, mortgage rates didn't move because the Fed bought mortgage bonds. Okay. During and they said they're not going to be selling these off, they're just going to let them roll. So you're not going to have a crash from them selling them off. They're not even thinking about that. It's not even on the table. So and during this period, the Fed was buying enough to keep mortgage rates at a level of 3%. Now they should have let it ride. We wouldn't have had this mess if they had, or they really should have done what they're trying to do by taming inflation a lot sooner. Okay, they started way too late. All right, they the whole transitory thing was they were completely wrong about that, or peaking, that was all wrong. Okay, and a lot of people knew it was wrong, but they sometimes can't see beyond the hand in front of their face. But if you even look at the way this works with inflation, how it works in correlation with each other, inflation will drive the mortgage rate. So the question is, when are they going to come down? We already know that there are forces out there that will cause inflation to drive in a lower direction, as it should, before we look at the reason for less money in the market. So which would kind of counteract that. So we're good, we're good from that standpoint if we look ahead about another month. Okay, so if the Fed can't really affect the core inflation. That's why they take out things like energy and food, because you're like, well, wait a minute, those things still cost me money, and they're costing me more money now, a lot more, to buy eggs and gas and things like that. But they can't really affect those directly. In other words, they can't control the weather, so how the crops are going to turn out. They have nothing to do with embargoes, or if a pipeline goes down, the Federal Reserve doesn't directly have anything with that. So they have other ways of trying to counteract that, those sorts of events. But sometimes those things come out of left field. But they look at the core inflationary rate right now, year over year. It's 6.3%, which is way too high. So the Fed target is around 2% typically. So how do we take how do we get that core rate? You take the individual monthly reading, you add them up, account for a little bit of rounding, a little bit of compounding, and you get 6.3%. So why did the market go crazy in September? Okay, because in early September we got inflation rate of, for August of 2022, and that replaced August of 2021. And the reading in August 2021 was super low. And, and this is why we mentioned rates would be going up later. So, you do the calculation and it went from 5.9 to 6.3, and the bond market said, whoa. And that's when mortgage rates really went haywire. Okay. Really went haywire. So as usual, right now, I would say if you can afford to buy a home, buy a home. You can get some really good deals right now. You can get closing costs on top of the closing cost to buy down your rate, and a really good deal. Okay. You can also, get things like 2-1 buy downs and all that. And I'm not going to get into details of what those are, but basically you can get lower interest rates through those sorts of things right now. And then as far as how long this is going to last, we may see rates come down a hair by the end of the year. There's a slight chance of that, but probably will be first quarter of next year by, mid to late first quarter. I would say the way things are running right now. That's what all the gurus that are typically right. And again, this is what's likely, right? It's always what's likely. Things like embargoes or heightened war conditions in Russia, the war that came out of nowhere, so to speak, with Russia, Ukraine, and then us printing more money to send over there, another inflationary factor that wasn't figured in to any of the equations. So you got to look at all these things as what's likely, and then there's always what could come out of left field. But we're going to be looking at we should be looking at under 5, possibly even around 4 by the end of the first quarter, okay, at the very latest. So even if, you bought as early as this year, most people have interest rates across the board over 5%. We see a lot of refis coming on. We also see a lot of first-time home buyers that'll probably be looking at things, right now, if a first-time home buyer or somebody is thinking, I have to buy, that may be a little bit of a rough thing. But if someone, could go from, say, selling a house, let's say, or first-time home buyers looking at 3 last year, but now it's maybe down to 4.5 in the coming months, then it might be like, okay, I can do that. I can manage that. I can make that work. That makes sense in my head. If it's a house I have to buy or really need to buy or want to sell the house I have now and move on, those sorts of things, right? So things start to loosen up, things start to coming back, and lots of goods in general start, selling after, stuff has been piling up because of less demand in, homes and other products, right? So there's a lot of misleading information out there, and it's true. Some of the markets, a lot of the markets have seen a little bit of a slowing in demand. For us in the last year, we went up 28% here in the greater Phoenix area. We are down about 9 to 10% right now from where we were. But if you do the math with me, okay, if you had an anomaly year and you went up 28% in 1 year and you dipped 9 to 10%, are you still ahead? Yes, you are still way ahead. And you're also way ahead of what the normal average equity gain would be, which would be about 4 or 5% here in the greater Phoenix area. Okay, 4.5 to 5% is pretty usual. So guys, the overinflated markets like Phoenix and Denver, yeah, they went way up. We're seeing a little slow period, a little bit of a correction, okay, due to that hit in demand because of the mortgage rates going insane because the Fed waited too long to do what they needed to do. And now, the question is, are they going to wait too long to lower the rates back down? Okay. So we get why, how the interest rates combat the inflation and what that means for the actual people who are investing in these loans on both sides and all that now. So, again, by first quarter next year, or by the end of first quarter next year. So, we're basically seeing, us getting back to a balanced market. So, this hysteria, the clickbait that's out there, the doom and gloom crowd, they're going to take their victory lap, on, going from 300,000 to 500,000, but now the houses were, or the home is selling for 480,000 or 450. You still made 150 or 180 on it, in like no time. So guys, it's very disingenuous. There's a lot of that clickbait out there. Don't fall for it. It's crazy. I got a great deal on a house just recently. And you know what? It appraised for more than I bought it for. So I got a really good deal. Got closing costs, paid on the rate a little bit. But I know I'm not gonna. I've gotta look ahead. You gotta look ahead. You gotta think, a little bit long term. You got to be smart about the affordability factor, and you got to look at. But rates are going to come down, and they always do. In a bad economy, rates come down. Rates come down in the bad economy. Think bad economy, rates come down. They will come down. So, a lot of people out there too in the crazy mainstream media, for the clickbait to make money on the boots or the car that's next to the the clickbait. Let's say there's 9 months of inventory out there. A lot of that's dirt. Okay, so a couple of things to keep in mind right now. Right now, we have 1.28 million net units in existing home inventory across the country. About 100,000 homes get destroyed every year. We need 1.7 million for new families being formed. New families being formed, about 1.7 million. And NAR says that the average across the country is 16 days on market. So that's a third of bubble-like conditions, because at the peak, the bubble-like conditions across the country were 3.81 million, okay, in inventory. And Phoenix, the bubble conditions were 56,000 homes, active homes, okay? And right now we're at around 19 to 20,000 any given day, okay? We're just over this week, we're just over 4 month supply, and a neutral market is between 4 and 6 month supply. So, and last week we we're at 2.3 months supply, just a week ago. So guys, those, and that fluctuates. We had just over 3,000 homes go under contract. We need about 5,000 homes to go under contract here in the Phoenix area. So the demand is low because of the interest rates, okay, and because some people are scared off by all the crazy clickbait out there, okay, the doom and gloom crowd. That's how they make their money. That's how they stay on the air, and that's how they stay online. And that's how they make their money. So, I don't want people to get worried. Plus, again, Jerome Powell said he's not selling off those mortgage-backed securities, so there's not going to be a crash from that standpoint. They're not even thinking about it. So, from April to July, we have we have a rise in inventory. Wow, what happened there? Well, guys, perspective is everything. Every year we have a rise in inventory from April to July, August, depending on your area of the country, and when it lets out, and when school's back in, because everybody wants to move for their kids, for their friendships, for their being in their teachers, normal cycle of everybody's life with families and stuff. It happens every year. Okay, so and build, for people sitting around waiting for the brand new home and the 200 to 300,000 McMansion. Keep in mind, builders also like higher price points for higher yields. Okay, so trying to time the market and just sitting there waiting for all this to happen, if you were waiting, I'm going to get into it, but if you were waiting over the last year, you're going to pay more for it now. You can get some good deals, but you're still going to pay more for it now than you would have last year. So there's 1.28 million units in inventory across the country. Now, keep in mind, that's brand new homes, right? Brand new homes that you could, move into, right? Well, you know what they don't tell you, or they don't mention, is what's actually from that number under contract. Okay, and this is actual homes you could move into, not dirt, right? So out of that 1.28 million, 501,000 homes are off market or under contract, and that's included in there. So, a home that may be closing in a week or whatever, that's included in there, but it's not even closed yet or not even available. So, but it's under contract. So active listings are really in reality 779,000. So we have seen, and a new inventory is really a new home that you can move into, not a resale, right? Because a resale home, a lot of those people are going to sell and then buy, right? So that's not really new inventory, right? So we have to, when we calculate these things, this is how it should be calculated correctly. So we've seen active listings way below normal levels, and they're already beginning to roll over and crest. And again, this April through July, August thing is a usual every year. You see it on the charts. So we're not in a housing crash overall, or prices may be down a little bit or slowed or stifled temporarily, slight correction, all that. But overall, we're all 18% across the country on average is what home prices went up over the last year. Okay. Now, some of the over super inflated markets like Phoenix, Denver, they're definitely seeing a little bit of a correction, but they're still way up right around the national average. So trying to time the market's really tough. You could certainly make a case for it, and I guess you could argue it, but usually if prices are down, rates are up, like we're seeing right now, or rates are down and there's more demand because of it, so prices are steadily on the rise, there's more competition, blah blah blah, right? So the way to look at it right now is you can get a good deal if you can afford to. You can get some really good deals on homes right now. You can do some negotiating. You can get some closing costs on top of that too, on buy down if you even need to do that. And then you could, do that refinance later on. So, and there's no out-of-pocket cost to do a refinance, and it's super easy to get done, super quick. Not a problem. Also, when you buy a home or do a refinance, if you close on it, let's say this month, next month you have no payment, so your first payment would be the following month on the first of the month. Okay, so in 3, 4, 5 years, 6 years down the road, you're going to do extraordinary. So not a problem. So so quick recap again, we're going to see rates under 5, maybe around the 4s, low 4s. Sorry, maybe even in the 4s by the end of the first quarter. And that means we're also heading into tax season, heading into the busy season, as usual. Once again, right into that. So things will start to pick up for sure. Now, further out you go, there's a lot more, what could be unseen, but likely this is the way it's going. As long as we don't see any crazy, other things like, printing more excess of money into an already inflationary, environment, these illogical things, sending more money into foreign wars, things like that. Printing more money for that. That's obviously going to throw the inflation off again. So let's hope that doesn't happen. And when you look where the housing market is today, a lot of people have been calling for the death of the housing market for a long time. A lot of this manufactured clickbait, like I said. But again, if you bought a home at $300,000, the home went up to $500,000. Now it's $480,000, $450,000, and they want to take a victory lap. It's very disingenuous. But overall, we're up, of course. And up over the typical averages. So again, on a new construction front, just want to drive this home a little bit more. Very misleading information out there, like I said. And a lot of the new builds were starting to catch up, but when you hear, okay, there's 9 months or 10 months of inventory in new construction, is very misleading, because that's dirt. So that's not for sale. So sales on completed homes, when you look at the completed homes, it's 0.86 months of actual inventory that you can move into. Okay, 0.86 months. That means that's less than 1 month, okay, of inventory, meaning that if they didn't build anything else or nothing else was completed, okay, nothing else was completed for that time period, almost 1 month, that there would be no new inventory, no new homes left to move into, which is like almost nothing. Okay. So it's still going to be a very tight overall market when we're forming 1.7 million households per year. And we're only seeing about 1.3 or just under 1.3 homes actually being completed that you can move into at any given time. Okay. So there's still a shortage in housing. New housing, again, isn't resale for the reasons we went over already. So at some point, you have to look at affordability. You have to look at affordability. What I mean is you have to stop renting and you kind of have to think ahead in compounding numbers. Okay. So rents went up at least 12, 13%. If you're going to rent, maybe you're not sure where you're going to live, you're going to move in 1 to 2 years. Yeah, rent, maybe it makes sense to rent. Okay. Unless you want to hold on to something for a long-term investment, you can afford to do that. And that makes sense. Okay. But, if you're going to, buy, if you can afford to, if you're going to be there longer and 3, 6, 12 months down the road, whatever, you can refi. And again, also like get a little breather, skip a payment around the holidays or this year or going into next year. Especially since with all this crazy inflation, basically Americans have lost an entire month's salary. Okay. And their 401ks are getting destroyed. So on affordability, when we look at that a little bit more, let's take a quick look at that before we stop here. Last year, if we take out a loan for 400,000, if you were to take out a loan last year for 400,000, let's call it $1,800 payment. That's around 3.5% using round numbers and mortgage rates. So 1,800 a month. Now, statistically, according to Fannie and Freddie Mac, the household earnings would have been about $9,000 a month. So this year we know real estate values have gone up overall, right? So let's just say the average appreciation was 18% across the country, which those are the numbers. That person would have to borrow 18% more now than last year. Okay. That which would be, instead of 400,000, 472,000 versus 400,000 from last year. So definitely is an addition. That's definitely an additional cost or more money. And the rates have also gone up about 3% using round numbers from that 3.5 last year. So let's say it's $1,100 in a month more in a payment. And, they stop there and they get scared, right? But what they don't factor in is, according to ADP, taking 25 million records, and if you stay at your job, you increased your job with the inflationary factors and everything that have been going on. Your job increased, your income increased 7.6% year over year. If you switch jobs, it went up 16.1% more. Okay. So it mitigates some of that gas and food stuff. Okay. Now, inflation has definitely gone up, and that's a thing. And it's, about $1,300 per month increase due to inflation. So, that's why, with income going up about $800, okay, that's why people are hurting right now, right? And, doesn't look, but you've got to look ahead and think about that for a minute. Stop and think about that for a minute. So let's not do what the Fed does and can't see our hand in front of our face. Let's think about that increase in income. Let's look at the next year. If you've got that mortgage in a fixed rate, your payments fixed, which most do, because now you've taken out that mortgage and secured that rate. Okay. The only thing that can happen is your payment can go down because, maybe you refinance it, no out-of-pocket costs, no penalties. But let's say you don't even do that. Okay. For whatever reason, why you wouldn't, but let's say you didn't do that. If it continues to go up, which they, according to ADP, is going up 7.6% if you stay at your job. Just if you stay at your job, not even talking about switching, which was more. Okay. That's now another year mitigating that entire increase so that you have a surplus in 2023. That's greater than the cost of demand destruction that's going on. Okay. In that demand destruction. So with that inflation. So also keep in mind, most people also have plenty of equity padding right now if they already own a home and they're thinking about doing any of this. So this is why you don't see a crash coming, on top of the fact that we have a lot more regulations in people getting home loans in the first place than we had in the last crash. And the last recession was caused by the actual housing crash and bubble. So if people look at the housing market, doom and gloom, yeah, we got a little bit of a rough patch, with the rates and demand and affordability and all that. But I believe we're going to see a resurgence, and that's why John Templeton said you want to be a buyer on the most pessimistic day, okay? Because that's where the real opportunities come in. There's a lot of pessimism, and this could lead to a very good opportunity right now. Very good opportunity, great buying opportunities right now. And then the rates go down and you refi, and now you got the deal, you got the closing cost to pay down the rate temporarily. The rates go down even more. You refinance, no out-of-pocket costs, boom. You've already, bought a home. Now you've skipped a rent or mortgage payment on the first purchase, and then you do it again on the refi. Not bad, kind of gives you a little pause a couple times there in a matter of 3 to 6 months or whatever. Boom. And you're getting the lower payment, a lower rate. Now, investments, people ask about, should I invest in rentals? Well, current vacancies are at 4.1% per year. While that's not an all-time low, you still have a lot of benefits in doing multifamilies or rental properties like that. A lot of investments out there that people are looking at like this. Should I do it now? Is now a good time to do it? But you really start to benefit with amortization. Most people forget about amortization. Think about that. And it is such powerful benefit that you receive, because although you may be laying out cash and a lot of it's for savings, so a lot of that equity is going to be, is going to equity, or a lot of that savings is going to equity. People don't always consider that. And appreciation, even modest rates, Albert Einstein said the eighth wonder of the world is compound interest. So appreciation is similar. The average investment property around 9 years, and that's the average, is around 9 years. If you were to take a look at the average over 9 years, and what the gurus are saying right now is going to be about 5.11%. Okay. The historical forecast or historical average is going to be about 4.5%. So let's just look at that 4.5% on a $400,000 property like this for investment for rentals. Say over the 9 years, it would be $195,000. If it was 5.11%, that's $280,000 just net, little difference. So there's a huge amounts of money to be made. And that's 17.6% over the 9 years with the compound. So, investment managers would say 15%. If you got you 15%, that would mean that they're rock stars in the Hall of Fame. This is 17.6% with that compounded amortization that we were talking about. So here's something interesting just to throw out there in relation to creating wealth and real estate. Very interesting. Top 1% of people needing net worth, the top 1% net worth is $10.8 million or more. This is from Kipling's, by the way. The top 2% is $2.5 million net worth. The top 5% is only $1 million net worth. The top 10% is $800,000, and the top 50% is $500,000. Reason why I bring this up is the study also found that 2 3/4 of that net worth came from real estate. So in the long term, you have to be in this real estate game. Okay. Guys, if you have any questions, feel free to reach out to me anytime. I'd love to be able to talk to you more about any of this or your local market. You can always reach out to us by phone or text at 480-788-8569, or email us at home@mincolagroup.com, or check us out online at mincolahomes.com and mincolagroup.com. Talk to you guys soon. Thanks.